The last chance to turn your situation around is coming. All it takes is the Federal Reserve printing money. And the moment that happens, every asset class that once collapsed can surge at the same time. In other words, as long as it's before the Fed starts printing, if you throw every dollar you have into investments, without a second thought, you won't have to do anything for the rest of your life. You just need eyes. Because the only thing you'll need to do is watch the numbers in your bank account automatically double, again and again. And opportunities like this have only happened twice in history. The first time was the financial crisis, 2008. The second time was the pandemic shock, when markets hit circuit breakers and everything froze. So today's video may be the most important video of 2025. Because at last, the good news has arrived. The Federal Reserve has announced it's about to go back to printing money. And what's even crazier, almost no one is paying attention. Which also means this: when others still don't know, but you already do, the wealth gap will stretch wider and wider. But here's the bad news. Is this round of money printing really good news or not? Financial Fortune here. Welcome, everyone. Now listen carefully. The asset banks buy the most of is U.S. Treasuries. Why? Because they're considered safe. Simply put, it's lending money to the U.S. government. And that is viewed as the safest thing you can do. But this is where the problem begins. After banks lend money to the U.S. government, it's basically like freezing their own funds. They lock up their money, and they run short of cash. And without cash, they can't lend to businesses and households. If businesses and households can't borrow, they go bankrupt. They shut down. And if banks can't roll their funding, even the banks themselves can fail. Then the economy can collapse. So when the Federal Reserve expands the balance sheet, it doesn't mean the Fed prints money and just hands it to banks to spend. If they did that, it would look like a bribe. A bank suddenly gets a pile of cash for no reason at all. How could anyone explain that? Everything has to happen through legitimate transactions. So what's the real issue right now? Banks bought U.S. Treasuries, and now they're short on cash. So wouldn't they get cash back if they just sold those treasuries to the Federal Reserve? Exactly. In other words, after the Fed prints money, it uses that new money to exchange for U.S. Treasuries held by the banks. Then, what happens next is simple. Treasuries move onto the Fed's balance sheet, and the newly created money moves into the bank's hands. Once banks have cash again, they can lend to businesses and households. Put even more bluntly, balance sheet expansion means this: the Fed prints money to buy U.S. Treasuries from banks. Now here is the key point. Right now, the Fed says it will create $40 billion per month to buy short-term U.S. Treasuries held by banks. At the same time, it will repay $15 billion previously lent to other institutions, and then keep using that money to buy treasuries again. So in total, that's $55 billion per month in treasury purchases. Now tell me, is that balance sheet expansion? Or is it not? So why do so few people realize the Fed is expanding its balance sheet? Because the Fed renamed it. In the past, expanding the balance sheet meant buying long-term U.S. Treasuries, and that was called QE. But now, expanding the balance sheet means buying short-term U.S. Treasuries. So they switched to a new name, RMP. But in substance, what changed? Isn't it still buying U.S. Treasuries? Isn't money still being injected into banks? Just because the label is different, public attention changes too. A lot of people, because of this new name, don't even realize the Fed is preparing to expand its balance sheet. Something this big, and almost no one is talking about it. That is not normal. Historically, the Fed has always been public. They loudly announce rate cuts. they loudly announce balance sheet expansion. Why? Because that's how they tell the whole world. An angel has arrived to stimulate the economy, meaning the Fed is the backstop. So what is there to fear? Anyone can go out, borrow money, and invest. That's why stimulus is always done with fanfare, to restore confidence. So why this time? Did the Fed even change the name and do it so quietly? Simple. Because this round of balance sheet expansion is not to stimulate the economy. Think back for a second. In 2019, before the pandemic crash, markets were overheating. Prices surged so hard that governments had to step in and restrict selling. Back then, the Fed printed about $60 billion per month to buy treasuries. And now, right now, every month, the Fed has to buy $55 billion of treasuries. So what on earth happened? And why this time does the Fed avoid long-term treasuries and instead buy short-term treasuries? When you see the full picture, you'll realize something critical. In 2008, when the Fed expanded the balance sheet, interest rates were cut to zero. In 2020, during the pandemic, it was the same. When the balance sheet expanded, rates were cut to zero again. In other words, first the Fed prints money, then uses it to exchange for bank-held treasuries. Banks swap bonds for cash, then lend that cash to capital markets and the US government at interest rates close to zero. So capital markets and the government can borrow massive amounts of money at nearly zero cost, and then buy up distressed assets at rock-bottom prices during a crisis. That is why, in the past, the Fed would cut rates to zero first, and only then expand the balance sheet. But this time, the Fed has cut rates, yes, even cut them 5 times. Yet, rates still aren't at zero. They're still at 3.75%. What does that mean? It means the US rate environment effectively has 2 states, either very high or zero. Before, borrowing in America was almost free. Now you're paying 3.75%. So your debt cost, hasn't it jumped more than 3 times? That is high interest. In other words, the Fed absolutely could choose to cut rates to zero first, and then expand the balance sheet, printing money to buy treasuries. But why this time would they accept a high rate of 3.75%, like borrowing at punitive rates, and still rush to expand the balance sheet? Is the Fed dragging out a crisis, or has the crisis already begun, and most people simply can't see it yet? If you don't want to become a sacrifice this time, and you still hope to break through the class barrier, then follow this channel. Because going forward, I will continue giving you more information and more signals that most people will miss. And if you're afraid you'll listen once and forget, and it all becomes a waste of time, then hit like on this video so it's automatically saved to your playlist. That way, anytime, you can come back, rewatch it, and follow the steps. Now first, the Federal Reserve is currently buying short-term US treasuries. What does that actually mean? Imagine, today, I'm a bank. I lend money to the US government for 10 years or 20 years. Then my money is frozen for 10 or 20 years. That's why, historically, whenever banks ran short of cash, the Federal Reserve would buy long-term US treasuries to unfreeze the 10-year and 20-year money banks couldn't touch. But right now, the Fed is helping banks unfreeze short-term US treasuries. Those are positions that mature in just 6 months to 1 year. Money the bank already has on hand. And all they need to do is wait 6 months to 1 year, and it unlocks automatically. The US government repays the bank. That's why short-term treasuries are usually treated as near-cash assets, because they can be turned into cash quickly, almost no different from cash itself. So here's the real question. if short-term treasuries will turn into cash so soon anyway? Why does the Federal Reserve have to rush to print money to help banks unfreeze them? There are two reasons. Reason number one, banks are truly out of money. They don't have enough cash to meet expenses, so they're forced to sell short-term assets first. It's like when you're desperate for cash, on the edge of bankruptcy, and you need money to keep breathing. The first thing you sell is your car, your watch, not your house, not your company, because you just need cash fast to survive, not to liquidate your entire life. Reason number two, and this one is more important, is that the house is losing money. So even if you need cash, unless you have absolutely no choice, you still can't sell it. Because selling now is the same as accepting a brutal loss. It's cutting into the flesh of everything you spent a lifetime building, and it can vanish into smoke. Banks are the same. Now look at the long-term U.S. Treasury bond ETF. Since 2020, its price has fallen 43%. At the worst point, it was cut almost in half. What does that mean? It means the long-term treasuries banks are holding right now are no longer worth what they used to be. So if you were a bank, would you accept the loss and cut the flesh? Let's make it concrete. Imagine you're a bank. You start with $1 trillion. You use that money to buy long-term U.S. treasuries, meaning you lend to the U.S. government for 20 years. Now, even if those long-term bonds have dropped by half in market price, as long as you keep holding and you wait until maturity, the U.S. government repays you. You can still get back the full $1 trillion and even earn interest. So that loss is just a paper loss. It hasn't hit your real cash position yet. But if right now you urgently need cash, and you sell those long-term treasuries today, you might only get back $500 billion. Then the paper loss turns into a real loss, and the value of your bank is instantly cut in half. At that moment, shareholders panic, depositors panic, they withdraw funds, transfer money out, and run, and your bank collapses. So the truth is, it's not that banks don't want to sell their long-term treasuries. They can't. Because the moment they sell, the loss becomes real. That's why banks have only one move left. They sell the shortest maturity assets they have, short-term U.S. treasuries, to the Federal Reserve, to get just enough cash to stay alive and keep the system turning. Now let's go back to the chart. In 2020, the Fed slashed rates aggressively and launched QE, printing money to buy long-term treasuries. That's why the red line kept rising. At that time, long-term treasuries were being bought in massive size, so prices surged. And there was a bank called Silicon Valley Bank. They bought a huge amount of long-term U.S. treasuries right near the top. Then in 2022, the Fed tightened aggressively and shrank the balance sheet, and long-term treasury prices collapsed. By 2023, Silicon Valley Bank ran short of cash. They were forced to cut the flesh, to sell long-term treasuries that were down almost 50%. And that triggered the bank failure. Meanwhile, other banks also held trapped long-term treasuries. But earlier, they had kept part of their money inside the Federal Reserve as required reserves. So when they needed cash, they could go to the Fed and withdraw those emergency funds. But when the whole banking system started entering crisis, those reserves fell sharply, down to around $3 trillion. After reserves dropped by $3 trillion, two banks failed. So the $3 trillion level became a red line, a warning that U.S. banks no longer had much cash to use. Back then, U.S. stocks had already fallen 27%, and now those reserves have dropped again to around $2.9 trillion. And once again, two banks have already gone under. So the Fed has no choice. It must transfuse blood into the banking system. and it has to expand the balance sheet quietly. Because it cannot let the world see that the US banking system is in trouble. Now the question is, why doesn't the Fed just cut rates all the way to zero and then expand the balance sheet? Because every time rates go to zero, the price of long-term treasuries jumps. So why not cut to zero now? So banks can unload their trapped long-term treasuries and sell them back to the Fed. Think about it. Over the past year, the Fed has cut rates 5 times, down to 3.75%. So did long-term treasury yields fall? You'll find something shocking. If you lend to the US government for 20 years, you can still earn a high yield, around 4.78%. Which means, after the Fed cut rates, long-term treasury yields did not fall. They actually rose. Why? Because no one is buying. So the government has to offer higher yields to attract buyers. In other words, the Fed's rate cuts no longer control long-term treasury yields or prices. The problem with long-term treasuries now is simple. There are no buyers. And if the Fed cuts rates even lower, the yield you earn gets lower. And even fewer people want to buy. So there is only one situation where long-term US treasuries will become attractive again. Only then can the Fed cut rates to zero and print its scale to buy bonds. And that situation is this: a financial crisis, a real crash like 2008 and 2020, when stocks collapse, real estate collapses, and every risk asset collapses. At that moment, the only safe asset becomes long-term US treasuries, because the yield is high, and the risk of the US government defaulting is viewed as the lowest in the world. So only by creating another financial crisis can money be forced out of risk assets and into long-term treasuries. Only then can the Fed cut rates to zero, expand the balance sheet, and print again. And you'll start to notice something else. The United States today looks like it's deliberately trying to puncture the AI stock bubble. So how did the AI bubble get inflated? It started when ChatGPT appeared, and suddenly the whole world believed that within just a few years, AI could replace human labor almost completely. So over the past few years, any stock even remotely connected to AI ran up like crazy, multiplying several times over. During the period from 2023 to 2024, we put most of our capital into US equities. Then by the middle of last year, we moved all the profits we made in US stocks into gold and silver. And then, in April this year, the market experienced the biggest crash in both stocks and bonds in the past 20 years. Right now, all of Wall Street is liquidating this first AI investment cycle, because they burned too much cash and got no profits back. So the stocks that used to rise the fastest are now falling the fastest. For example, Nvidia, which I mentioned in previous videos, is already down more than 20%. Oracle is down 48%. Meta, at one point, was down as much as 26%. Meanwhile, silver, since we bought it, mostly surged hard, then only pulled back slightly. Earlier, we were forced to take partial profits, but very quickly, we bought back in. And now, without using leverage, the value has nearly doubled. Gold, just this year alone, has delivered roughly 50% returns. But I'm not saying this to brag. I'm saying it because I want you to understand one thing. Investing has to focus on the core. You don't chase what's difficult. You chase what matters. You'll realize that during 2022 through 2023, when we invested in the US, it was a major bull market. So after we entered, it was rare to ever need a stop loss or a take profit. We simply held. We didn't need to think much. The market itself made money for us, automatically. And in 2025, gold and silver are the same. Basically, you don't need to trade constantly or stare at charts all day. Once we set the stop loss and take profit levels, the mechanism only triggers once or twice. But if I took this same money and invested it in US stocks right now, maybe I could still make money, but I'd have to accept the April crash and the current risk, because US stocks are still at high levels, and the next burst can happen at any moment. So with the same amount of money, why would I choose the market that's harder to profit from instead of gold and silver? The kind of assets you barely even need to watch to know they'll rise. That's why choosing the right market, the right asset class, and the right timing matters more than anything, because that directly determines your probability of making money and how easy it feels to earn it. Now let's return to the core issue today: the Federal Reserve buying short-term US Treasuries can be understood as a temporary emergency measure, meaning banks first sell their shortest-term assets. Just like when you urgently need cash, you sell your watch or your car first. But if after selling those, the money still isn't enough, what happens next? Then banks have only one option left. They accept the loss and sell their long-term treasuries. And at that point, to protect the entire banking system, money can only be forced out of risk assets, like US stocks, and into long-term US treasuries. So what consequence does that create? On this chart, the red line can be understood simply as how much leveraged money is being used to invest in stocks. The higher the red line, the more borrowing people are using to chase the stock market. That's why, before the dot-com bubble around 2000, and before the financial crisis, 2008, this red line surged sharply, meaning the bubble pressure was extreme. Countless people borrowed money to buy stocks. And today, the borrowing frenzy is already almost identical to 2000 and 2008. Which means, if US stocks collapse, the destructive impact could absolutely be comparable to those two major crises. Now look at the other two lines. They represent the income foundation of ordinary Americans. The dark blue line represents US stocks. The light blue line represents the US economy. Before the 2008 crisis, these two lines almost overlapped, meaning when the economy was strong, stocks rose. When the economy weakened, stocks fell. But after the Fed turned on the money printer in 2008, these two lines separated and drifted farther and farther apart. US stocks kept rising, while the real economy didn't grow much at all. Yet prices in America, up to this day, have effectively doubled. So what does that represent? It represents a reality. For ordinary Americans, if you rely only on wage income from a job, life becomes harder and harder. In the past, $3,000 a month could support an entire family. Now, even $5,000 a month can sometimes be enough only for one person. Wages don't keep up with inflation. Real income is being squeezed. So how did Americans manage to keep living the same way and even consume like crazy, supporting roughly 70% of US economic growth? The answer is right here. More and more Americans, the moment they earn money, don't buy bonds. They don't buy insurance. They buy stocks. More simply, today, Americans can't rely on working a job to build wealth anymore. So everyone goes into the stock market. Some even borrow money to buy stocks, because since 2008, the speed of making money from the stock market has been far faster than working for wages. Not even close. And that's exactly why. Even if their wages haven't increased much, even if everything in America keeps getting more expensive, their wealth can still surge because they invest in stocks and even use leverage. To put it bluntly, if you live only on fixed salary income, you will only become poorer over time. The only path is to move money into the stock market. In other words, it's US stocks that have increased Americans' wealth. And when Americans feel wealthier, they spend more. And that's what truly pushes the US economy forward. So in summary, US stocks have been pulling the US economy. Only if stocks keep rising long-term does the economy appear to improve. So does that mean America cannot allow a stock market collapse or a financial crisis? Actually, no. They can allow it. They just make the collapse period very short. The collapse will still happen. For example, in 2020, when the pandemic erupted, US stocks still crashed. Everything hit circuit breakers. And when capital was forced into long-term US treasuries, the Federal Reserve immediately cut rates to zero and then printed on a massive scale to rescue the system. The big crash in both stocks and bonds in April this year was the same kind of signal. Even though they failed to push money cleanly into long-term treasuries, the Fed still could not cut rates to zero and could not print at full scale. But the US government moved fast. They immediately delayed tariffs and rolled back the bad headlines. In other words, America can allow major drawdowns to happen, but it will keep the collapse window short. Because if a collapse lasts too long, it starts to damage the real economy. But if they never allow a collapse at all, then money cannot be forced into long-term US treasuries. And if money cannot be forced there, the Fed cannot cut rates to zero, cannot print at full scale, cannot transfuse the system, and cannot push US stocks even higher again. Which means the next collapse, in terms of severity, could be comparable to 2000 and 2008. But the duration will be very short. And that short window is exactly the moment for a massive asset rotation. Asset owners will be forced to sell cheap. People without assets may be able to buy those discounted assets. But the time to buy the bottom will be extremely short. That's why right now, the Federal Reserve has been forced to step in, buying short-term US treasuries, because banks no longer have enough cash to keep the system rolling. So the next step, the moment the US must crash to force money into long-term US treasuries, is that moment getting closer and closer? That is exactly why, during this period, I personally do not participate in US equities. Instead, I let gold and silver continue to increase my wealth, offensively and defensively. I can advance when conditions are good, and I can defend when conditions turn. And when the timing finally matures, when US stocks are rebuilt and a real entry point appears, I will use the profits earned from gold and silver to redeploy back into US equities. If today's video helped you understand deeper, I also welcome everyone to leave different viewpoints in the comments and discuss rationally together. And if you feel there are parts you still don't fully grasp, I suggest you rewatch 2 or 3 of my videos from last week, because the entire logic chain is tightly connected. Due to limited time, I'll end here. I share information for free on how to become wealthy, how to become an entrepreneur and investor, and how to achieve financial freedom. If you don't want to miss what's next, I still ask you, subscribe to the channel, turn on notifications, and share this video widely. I sincerely wish everyone who hit like on this video achieves financial freedom soon. As long as, in everything I said today, you found even 1 or 2 sentences that were useful, that can make your life a little better, then I'm satisfied.